In the topic of changes to Sharia compliant status of stocks, we are covering the reasons on how it happened, the effect after the changes, and as well as the other observations. There are many reasons for inclusion and exclusion of Sharia index. We identified at least 3 factors, which are the qualitative factor, the financial ratio, and the factor of mergers and acquire other businesses. For the factor of qualitative, it involved the company of Carex Berhad, which they manufacturing condoms. In 2002, this factor was considered as bad image, and this company was classified as non-Sharia compliance due to the 5% benchmark. Nevertheless, in 2021, condoms were seen as a medical purposes tools. With that, Carex Berhad was considered as neutral and was removed to be screened by the SAC. In May 2021, Carex Berhad was classified as Sharia compliant company. Next is the factor of financial ratio. Digi.com was originally a Sharia compliant company, but in 2016, the MCMC has relocated higher spectrum price that the mobile services company have to pay to them. Due to this, the Digi.com had to borrow the money from the bank as a loan, and leads the financial ratio of Digi.com increases to 41%. After that, Digi.com had removed from the Sharia compliant list due to the exceeding 33% benchmark. In the factor of business merger and acquire other company, it involved the company of DKSH Holding, where they acquired the company of Auric Pacific. Originally, DKSH Holding is a non-Sharia compliant. Due to the acquiring of Auric Pacific, the revenue of the whole group is less than the specified benchmark. Due to this, they are listed in the Sharia compliant company list. As for the investors' approach, most of the investors took the decisions to move their fund from the non-Sharia compliant stocks to Sharia compliant stocks. Nevertheless, the investors would usually invest in the companies that are within the same industry that they have invested in before. For example, investors A invested in AirAsia, and after the deletion from the list, he sells the shares and invests in AirAsia X. For the effect of stock price, in general, added firms would result in the short-term positive price effect, while the deleted firms would result in the short-term negative price effect. The implication towards this is temporary price changes, in which the price will be changing in a short span of time and revert back in the long run. For trading volume, a research was conducted upon the revised benchmark in November 2013. Based on the findings, the non-Sharia compliant companies recorded negative cumulative average abnormal return, while the Sharia compliant companies recorded positive cumulative average abnormal return. The reason behind the negative value was because most of the investors sell their shares and invest in the Sharia compliant stocks. In summary, once a company had their status changed, whether to Sharia compliant or non-Sharia compliant, it gave impacts towards the stock's trading volume, as it influenced the investors' behavior in buying and selling the company's stocks. Does Sharia status of stock matter to the firm management? A study we found about firms in GCC countries answered yes, it matters in relation to financing management of the Sharia compliant firms. It revealed that Sharia compliant firms tend to have higher cash holding level as opposed to their non-Sharia counterparts. This particular method is to ensure their financial ratio are not exceeding the specified benchmark due to excessive practice of conventional loans, bonds, or shares trading. For observation, we are observing the calculation for financial ratio, which are asset, base, and market capitalization. Nevertheless, the total number of companies becoming Sharia compliant may differ when using each screening method. We compared and found that it is due to at least 3 factors, which are the business nature of each country, the health of the economy, and also depending on the sector of the companies. For the nature of the business, GCC countries focuses their business on gas and oil, which uses more assets in order to operate their daily operations. Due to the high value of assets, they are using asset-based screening to calculate the financial ratio in order to achieve the 33% benchmark. Different from the companies that have lesser assets, such as companies that focus on technologies and innovations, they preferably use market capitalization screening to calculate the financial ratio, since it will obtain better results. For the health of the economy, usually if the economy is in good condition, each company would have a great value of shares trading, in which it is better to use market capitalization screening instead of asset-based screening to calculate the financial ratio. Nevertheless, if the company is in crisis, it is better to use asset-based since the market is not still recovered, which would result in a lower ratio. Lastly, the sector of the companies. If the company is in technology sector, they have a lesser amount of asset, but they are growing their companies by attracting the investors through the capital gains from the shares trading. Due to this, when using market capitalization screening, the companies under this sector would accumulate better ratio than using asset-based screening. Different from the sector of utilities, usually investors are not attracted to the shares. In order to achieve the benchmark, this sector would preferably use asset-based screening. That was all from us. Thank you.